Imagine this. You have worked all through for 15 to 20 years in Lagos, London, Joburg, and even Toronto. You have been sending money home, paying school fees, investing in good funds, and on one random Tuesday, you open your investment app. Voila, your portfolio is down almost 40%. But in that moment of your panic, somewhere, another investor is calm and smiling because the same crash that is hurting you is making them richer. This is not down to luck, but rather because they follow a simple 4-stage playbook which quietly shown up in the years 1929, 2008, 2020, and could be repeating anytime soon. Today, for Nigerians and Africans at home and in the diaspora, we're going to break that pattern down in simple English. No jargon and no intimidation. Disclaimer. This is not financial advice. It's financial education, Moloney Street Re, and My Wali style. So you don't end up the last person holding the bag. When markets get crazy, overhyped, overleveraged, overpriced, the smart money tends to follow a repeatable pattern. Stage 1, quiet exit. They start taking profits and raising cash while prices are still high. Stage 2, buy insurance. They pay small amounts for protection that explodes in value if markets crash. Stage 3, target weak links. They bet against the most fragile sectors, the bubbles inside the bigger bubble. Stage 4, buy at maximum fear. When everyone else is screaming, sell, they use their cash to buy quality assets on sale. Most normal investors do the opposite. We ignore risk in the good times. We are shocked in the crash. We sell near the bottom, then we watch, powerless as markets recover without us. Let's go through each stage with real stories and then talk about what it means for you. Section 2, Stage 1, leaving the party early. Think of the market like a big party. At the start, it's quiet and relaxed. In the middle, everyone is there. The music is loud, energy is high. Near the end, a few smart people quietly slip out. Then suddenly, the DJ stops, lights come on, and the rest are shocked it's over. That's Stage 1. The smart money doesn't wait for the crash announcement. They just look at the numbers and say, risk is now bigger than reward. Time to reduce exposure. In the late 1920s, the US stock market was booming. People were borrowing huge amounts to buy stocks. Margin debt was extreme. Just a small drop could trigger forced selling and panic. Joseph Kennedy, a successful speculator, saw this. There's a famous story that he knew it was time to get out when his shoeshine boy started giving him stock tips. True or not, the deeper point is simple. When everyone is confidently speculating, including people with no real information, who is left to buy from you? So, months before the 1929 crash, Kennedy began quietly selling and moving to cash. While others were fully exposed, he had already stepped aside. Fast forward to the mid-2000s, Michael Burry and John Paulson looked closely at US housing and saw loans given to people who couldn't afford future payments, stated income, mortgages with little verification, prices completely out of line with local incomes. Everyone believed house prices never fall. But the data said otherwise, so they began their own Stage 1, reducing exposure to the popular housing trade, refusing to join the "it can only go up" crowd, and getting ready to position for the downside. They looked early, they looked wrong, until they were suddenly very right. Stage 1 isn't about predicting the exact crash date. It's about having the courage to step away from the crowd when valuations and risks no longer make sense. Now, Stage 2, buying insurance. Imagine you live in a flood-prone area. You pay for insurance every year. If nothing happens, the money is gone. If a big flood hits, the payout saves you. In markets, the smart money does something similar. They buy put options that gain value if prices fall. They use volatility products that pay off when fear spikes. They buy credit default swaps, insurance against loans and bonds defaulting. So you're paying money every month for something that might not happen? Yes, that's exactly how insurance works. In the 2005 to 2007 housing bubble, Burry and Paulson paid premiums for years. On paper, they looked wrong while the party continued, and their investors complained. But when defaults finally exploded in 2007 to 2008, those small premiums turned into billions. Stage 2 is simple in spirit. Buy protection before the disaster is obvious. Stage 3 is more aggressive. Instead of just insuring their portfolios, the smart money asks, which parts of this system are most likely to break first? In 2008, that meant specific subprime mortgage bonds and specific banks holding too much of that toxic stuff. Investors didn't just short the whole market. They went after the weakest pillars. In any bubble, some areas are more fragile than others. Over-leveraged sectors, overhyped themes with no real cash flow, and institutions sitting on assets that only work if everything stays perfect. Again, you don't need to copy the exact trades, but you can copy the thinking. Where are things clearly weakest, and do I really want my family's future sitting there? For most of us, stage 2 and 3 don't mean becoming options traders or hedge fund managers. They mean holding more cash and safe assets in risky times, avoiding crazy leverage, and not overloading on obviously fragile sectors. Now we get to stage 4, the part everyone says they want. I'll buy when the market crashes. But in real life, when the crash actually comes, news is full of doom. Social media is panicking, your friends are selling, and your own portfolio is bleeding. It doesn't feel like opportunity, it feels like the end. That's why stage 4 is less about intelligence and more about preparation and emotional discipline. After the 1929 crash, the US market didn't just drop a bit, it fell almost 90% over a few years. Most people were wiped out. But Joseph Kennedy, who had exited early and profited from the fall, now had cash. He used it to buy real estate from distressed sellers and businesses and stocks at absurdly low prices. That's how a crash turned into generational wealth. In 2008-2009, fear was everywhere. But investors with cash, like Warren Buffett, stepped in, injecting capital into strong institutions on very favorable terms, buying quality companies when everyone else wanted out. Those decisions paid off massively over the next decade. Same pattern, different crisis. So let's bring this home. As a Nigerian or African at home or abroad, you may not run a hedge fund, trade options, or analyze mortgage data, but you can still borrow the mindset of the 4 stages. Here's a simple version, the Maiwali style. Stage 1. Don't be the last buyer. Take some profits on big winners, cut obvious nonsense and scams, and reduce or avoid high interest debt used for investing. Stage 2. Build your safety net. Keep a reasonable cash buffer or safe assets. Don't risk money you'll need in the next few years. Diversify not all in one country, one stock, one theme. Stage 3. Avoid obvious weak points. Be careful of sectors with huge debt and no real earnings. Don't overload on hype just because everyone is shouting about it. Stage 4. Prepare to be brave later. Build a shopping list of quality stocks and ETFs now. Decide in advance. If prices fall 40 to 50%, I will start buying slowly. Think in 5 to 10 year horizons, not 5 to 10 days. You don't have to play all 4 stages perfectly. Even applying 10 to 20% of this thinking can make a huge difference over a lifetime. Market crashes are not new. They're not the end of the world. They're part of how the system resets. Some people get wiped out. Others quietly level up. Welcome to Moloney Street Re, where we make money, investing and wealth creation simple for Africans at home and abroad. Alongside this, we're building My Wali, a platform designed to pool your stocks, property, Esusu groups, pensions, side hustles, and savings into one clear dashboard so you can finally see your financial life in one place. If you want more breakdowns like this, smash the like button, subscribe to Moloney Street Re, click the notification bell so you will be notified whenever we drop a new video, and leave a comment below. And share this with someone who's investing blindly, education only, not financial advice. Always do your own research. In the comments, answer this. If markets dropped 50% in the next 18 months, what do you wish you had done in stage 1? And what would be on your stage 4 shopping list? Crashes will come and go. The question is, when the next one comes, will you be confused or prepared?